No, not 25. We've solved 25 now. We have solved question 25. The one, okay. Case study 24. This is for November. This is for May 2023 diet. So let's take this one first. Case study number 24. We know we've done 25 the last time now. So I need somebody to kindly read this for us. Case study 24. That's May 2023 question. Oh yeah, who is reading, please? Anyone reading?
OMI PLC acquired 80% of the ordinary share capital of RUA Limited on 1st December 2017, when the retained earnings were 400 million. The fair value of the net asset of RUA Limited was 2,840 million. Any fair value adjustment related to the net current assets and these net current assets had been realized by 30th November 2020. There had been no issue of shares in the group since the current group structure was created. OMI PLC and RUA Limited had acquired their holdings in Mimi Limited on the same date as part of an attempt to mask the true ownership of Mimi Limited. OMI PLC acquired 40% and RUA Limited acquired 25% of the ordinary share capital of Mimi Limited. OMI PLC acquired 40%. The retained earnings of Mimi Limited on that date were 200 million and those of RUA Limited were 600 million. There was no revaluation surplus in the books of Mimi Limited on December 1st, 2018. The fair value of the net asset of Mimi Limited at December 2018 were not materially different from their carrying amount. Additional information 3. The group operates in an information technology sector and has incurred a significant amount of expenditure on the development of various internet products. Those costs were formally written off to the statement of profit or loss as incurred, but then reinstated when the related internet products were brought into commercial use. The reinstated costs are shown as development inventories. The costs do not meet the criteria in IAS 38 intangible assets for classification as intangibles, and it is unlikely that the net cash inflows from this product will be in assets for classification as intangibles, will be in excess of the development costs. In the current year, RUA Limited has included 80 million of this cost in inventory, of which 20 million relates to expenditure on a product written off in periods prior to December 1, 2017. Commercial sales of this product has commenced during the current period. The accountant now wishes to ensure that the financial statements comply with IFRS as regards this matter. RUA Limited had purchased a significant amount of new interest equipment during the year. The cost before trade discount of this equipment was 200 million. The trade discount of 24 million was taken to the income statement. Depreciation is charged on straight line basis over 6 years period. The policy of the group is to state the PPE at depreciated historical cost. The group changed from the revaluation model to the cost model under IAS 16 PPE in the year ended 30th November 2020 and restated all its assets to historical cost in that year except for the PPE of Mimi Limited, which had been revalued by the directors of Mimi Limited on 1st of December 2019. The value were incorporated in the financial records, creating revaluation surplus of 280 million. The property, plant, and equipment of Mili Limited were originally purchased on December 2018 at a cost of 1,200 million. The assets are depreciated over 6 years on straight-line basis. The group does not make an annual transfer from revaluation reserves to retained earnings in respect of the excess depreciation charged on the revaluation property, plant, and equipment. There were no additions or disposals of the PPE of Mimili Limited for the 2 years ended 30th November 2020. Additional information 6. It is the group's policy to value NCI at acquisition at their proportionate share of subsidiaries' identifiable net assets. Additional information 7. During the year, the directors of OMI PLC decided to establish a defined benefit pension scheme for employees of the parent company and contributed cash to it to the tune of 400 million. The following details relate to the scheme as at 30th November 2020. Present value of obligation 520, fair value of planned assets 500, current service cost 440, interest cost 80, expected return on pension assets 40, actual gain 60. The only entry in the financial statement made to date is in respect of cash contribution, which has been included in OMI PLC's trade receivables. The directors have been uncertain as to how to deal with above pension scheme in the consolidated financial statement because of the significance of the potential increase in the charge to the statement of profit or loss relating to the pension scheme. They wish to recognize immediately any actual gain in statement of profit or loss. Required, prepare consolidated statement of financial position of OMI Group for the year ended 30th November 2020 in accordance with relevant IFRS.
Okay, so this question is your last diet question, November 2023. So May 2023, if you can recall, this question is almost similar to this one, case study number 25, Ramdam Town. Some of the notes, in fact, I can pick like 2 notes that are very similar. This is Ramdam Town. This note on tangible asset is exactly the same thing. Okay, in Ramdam Town, they also repeated the same notes. Then look at this note on this, what's it called? The one on the development inventory that we have in Random Town. It's also the same thing that you have in that same question, right? Then look at this note on trade discount on PPE. So 3 significant notes were repeated here, exactly the same thing. So that is the importance of solving past questions. So if I shouldn't have solved these questions for you, because based on what we did in Ramdam Town, you should be able to solve this because at least 3 notes are the same. That's note number 3 here. This one, note number 3, note number 4, and note number 5. They are the same with the Ramdam Town we solved the last time. So you can see the way I can set their question. The only new things here is this IAS 19, that's employee benefits. So this one is not a problem. I will run you through this. However, so I'm going to follow the same tactics I used the last time. I will treat all the notes to you for you, calculations, everything. Then you will go and balance the balance sheet or the SOFP on your own because of time. So I needed to solve 2 questions for you and also have to exit this call by 9 a.m. on the dot. So I will treat all the notes for you. Then you go and solve the accounts. So let's start now. I have my workings. So first one is shareholding or acquisition analysis, right? Acquisition analysis. Let's take this first. Acquisition analysis. So let's read now. The first one says that OMI PLC acquired 80% of the ordinary share of RUA on 1st December when the retained earnings were 400. So the first one says OMI in RUA. That's 80%, Abby. Please, you can unmute so that you follow me. OMI in RUA. That's 80%. So in this case, the NCI is going to be 20 cents. Okay, that's the first thing we have. Then, so everything we have in note 1, is relating to the same OMI in RUA. So you are told that when they retain anywhere 400 million and the fair value of the net asset of RUA was 2.840 and any fair value adjustment related to net current asset, and this net current asset has been realized. So I will show you the treatments when it has been realized. So that's for that. Then note 2. OMI and RUA had acquired their holding in MIMI on the same date as part of an attempt to mask the true owner of OMI. So OMI acquired 40% in MIMI Abi, and RUA acquired 25%. So let's say OMI in MIMI Lil or something. How much is OMI in? Is it MIMI? What's the spelling? MIMI
40%.
Li. OMI acquire 40, Abi.
Yes.
OMI
Yes,
acquire
sir.
40. Then RUA in
Acquire 25%.
MIMI. RUA acquire 25%, Abi.
Yes.
So the first thing you need to do, this is more or less like a joint or mixed group. Are you guys with me? This is a joint or mixed group. So the first thing you need to do is to analyze the group structure. So you understand? The first thing you do is to analyze the group structure. So this is exactly what we have. We have something like this. So this is OMI. This is RUA. And this is MIMILI. You know, OMI acquired 80 in RUA, Abi.
Yes.
That's 80. Okay. Then OMI in MIMILI, 40. So this one is 40. Then RUA in MIMI is what? What's wrong with this?
25%.
What's wrong with my mouse this morning? It's just misbehaving. 25, Abi.
Yes, sir.
Let me type it somehow. 25. So anyway, as long as you understand what I'm showing you, that's all. So this is exactly what we have. So based on the principle I taught you, the first thing you do is to convert the group structures to fellow subsidiary. So you have to convert the group structure to fellow subsidiary. So you say convert the group structure to fellow subsidiary. So how? How do you do that? OMI in RUA, that one is clear, it's straightforward. That's 80%. Then we have OMI in MIMILI. OMI in MIMILI now we'll be having direct and indirect. So what is the direct here? How many percent is OMI in MIMILI direct?
40.
40, Abi. So what is
Yes.
the indirect? Tell me the indirect. The indirect is what? Hmm?
10.
20%.
That's
10.
80% of 25%, Abi.
20%.
This gives
Yes,
you
20%.
it's 20.
20%.
So we have what now? We have 60, Abi. We have 60. So what this signifies is that our group structure is not going to be OMI in RUA 80 and OMI in MIMI 60, Abi. So you are not done yet. So the first thing you do again is your purchase consideration. So for the purchase consideration, you know that for OMI in RUA, that one is very straightforward. How much did OMI pay to RUA? Just check the account, it's 2560, right? Am I correct?
Yes, sir.
250. I'm a little bit fast because this is like a revision. So anything I'm teaching you, nothing is new again. However, if you require what's it called further clarity, please call me back. I'm not teaching now, I'm just doing a revision with you, like I'm playing with you. So for the purchase consideration, how much did this guy pay for the direct? How much did OMI pay RUA for direct purchase consideration? I mean, how much did Omi pay to Mimili for the direct?
640.
640.
640. Perfect. Then 640. How do we, what is going to be the indirect then? Tell me the formula for the indirect. What is going to be the indirect? So, the indirect is going to be, Omi acquire 80% in Rua, right? So it will be 80% of what Rua paid to Mimili. So how much did Rua pay to Mimili?
400.
How much?
400. 400.
400. It's 400, right? So it will be 80%
Yes.
of that 400. So it will be 80% of 400. How much, please?
320.
320. So
320.
what,
320.
what's total purchase consideration now? Total. That should be 960, right? Huh?
Yes, sir.
960. So now we are done. We have crossed the obstacle. So with this now we can even calculate our goodwill. But I would advise you don't rush to calculate goodwill. Quickly finish the other notes. So now we are done with note 1. So note 1 and 2, we can calculate our goodwill based on the little information that we already have now. We can calculate our goodwill. Okay. Now, so let's treat note 3. Let's finish the remaining notes. So we have about how many notes? I think we have about 7 notes. So let's finish all the notes. Then when we finish all the notes, we'll calculate our goodwill. Although you can still go ahead and calculate your goodwill, no problem now with this information. But let's quickly finish everything so that we'll just calculate goodwill, reserve, and NCI to end the question. Abi? So I want to take note 3 now. Let me bring it here so that we can solve it here. Note 3. Okay. This is similar to the one we did the last time. Under Ramdam Town. It's very, very similar. So let's read now. The group operates in an information technology sector and has incurred a significant amount of expenditure on the development of various internet products. These costs were formerly written off to a statement of profit or loss as incurred, but then reinstated when the internet products were brought into commercial use. The reinstated costs are shown as development in inventory. Then these costs do not meet the criteria of IS 38 for clarity. So with this statement already now, they incur some development costs, which they have already written off to P or L. Are you getting the story? They incur some costs on development, which they have already written off to P or L. However, when the product was now launched, they now feel like in their wisdom that the cost that they have already written off to P or L, that those costs should be reinstated when the products become live. However, this statement shows that these costs do not meet the criteria in IS 38 intangible assets. So this alone is a knockout punch. If you watch boxing, when both of us are fighting boxing and I give you a knockout punch, that's the end of the fight. So this point that you are told that these costs do not meet the criteria in IS 38. So that means they cannot capitalize the cost. Initially they took the cost to P or L, right? They now later, when the product was now launched, they now restate it back, they capitalize it. But now they said that those costs do not meet the criteria. So that's a knockout punch. So what it simply means is that whatever cost they capitalize, you have to now reverse it back to P or L. That's your answer. So in the current year, RUA had incurred 80 million of this cost. So it is this 80 million gone that you need to now send back to P or L. So of this cost, in which 20% related to this expenditure on the product, forget about this one, is a distraction. What you want to know is how much total cost was reinstated. That is 80 million. So this 80 million that was reinstated, and we're told that this cost does not meet the criteria in IAS 38. So what you will just simply do is to send it back to P or L. Okay. So sorry, I obviously understand this is clear to everybody. Reclassification of development inventory. So what we will do now is that we need to remove the cost. We need to take the cost to P or L. So you debit your P or L, that's 80. Then you credit your inventory, that's 80. Okay. Being cost reclassify to P or L because it does not meet with the criteria under IAS 38. This is just like an explanation. I'm not saying you must write this in your solution. So I'm just trying to lay an emphasis on my explanation. Sorry, is this clear to you guys, this analysis of note 3? Let me take your feedback.
Yes.
It's clear, Abi?
Sir.
Okay, perfect.
Yes,
so
sir.
thank you so much. Let's move on. So we are done with note 3. Now let's look at note 4. Note 4. You can this note 4 too. We did something like this under random tab, but we will do it for you. So ICANN doesn't. They don't really have new question again, my people. It's just the same thing we recycle every time. So all these past questions, if you can practice all of them, and I think I've done more than 90% of them for yourself. So you just practice all these things and go for your exam. All these questions are being recycled. Now you can see about 3 or 4 notes were just repeated. Okay. So this one says RUA had purchased a significant amount of new internet equipment during the year. The cost before trade discount of this new equipment was 200 million. The trade discount of 24 million was taken to the income statement. The recipient is charged on straight line basis over 6 years. So, okay, what they have done here is that, under IAS 16, you are supposed to recognize your fixed asset at cost net of trade discounts. You should recognize your this thing at cost net of trade discount. That's what the standard says. You should recognize your PPE at the cost net of trade discount. So what they have done is that they have recognized the full cost. They now took the trade discounts to P or L. That is wrong. So trade discount should not be recognized in the P or L. It should be used in reducing the cost of the equipment. You don't recognize your trade discounts in P or L. You use your trade discounts to reduce the cost of what? Equipment. But here they have recognized the trade discounts to P or L. So all we need to do is to adjust it back. And also they have been charging depreciation on the higher value. So there are 2 things here. The first one is to reclassify the costs. Then the second one is to adjust for the excess depreciation. Okay. First, we will reclassify the trade discounts. Then the second thing is to now treat the excess depreciation. So yeah, let's discuss now reclassification of trade discounts and excess depreciation. So in this case now, the trade discount is how much now? 24 million. They are supposed to recognize this equipment as 200 million minus 24. That should be about 176, right? Okay, they should recognize it as 176 because according to IS16, your PPE should be recognized at cost net of trade discount. So be that is me, this trade discount that they have taken to P or L this trade discount was taken to income statement. They recognize as income, so we'll reduce it. How? So you just debit your P or L. You remove the income from your P or L, then you credit your PPE. Okay, that's the first thing you do. But this is not the end. Then you now need to pass entries for the excess depreciation adjustment. Excess depreciation adjustment. Excess depreciation adjustment. So what is excess depreciation now? They will have been charging depreciation at 200 million instead of charging depreciation at that's 176, right? The true cost of the equipment is 176. However, they have been using 200 million. So what it means is that they have been charging more depreciation. Okay, how do you calculate excess depreciation? Just divide the excess depreciation is equal to this 24 divided by how many years? 6, Abi. How much is this, please? This should be 4. Am I correct? Hmm?
Yes, sir.
I'm correct.
4 million.
I'm correct, Abi. So what you would do now, since we know that it is 4, so what you would now do is this. So you credit you credit your P or L with the 4. I mean, you credit your P or L, you take it back to P or L. No, excess depreciation means they have been charging more. Sorry, don't mind me. You credit your PPE, you need to reduce the depreciation from PPE. You credit your PPE with 4. Now, what are you going to debit now? You know, this thing is RUA. RUA is what? RUA is a subsidiary, right? RUA is a subsidiary, correct? We own 80% in RUA. Am I correct, guys?
Yes, sir.
RUA is a subsidiary, so that means this adjustment must be borne by both the group and NCI. So you debit your group P or L, and you debit your NCI. That's 80-20. What is 80% of 4? What is 80% of 4?
3.2.
0.2 goes to group P or L, then we have 0.8 for NCI. So that's the end of these notes. Okay, we are done with note 4. So let's move on to note 5. So back to the question. Okay, this is the next note. You remember that something like this too. We treated it the last time as well. We treated something like this the last time. So let's repeat it again. It's the same note that they repeated. It goes thus. The policy of the group is to state the PPE at depreciated historical cost. The policy of the group is to state the PPE at depreciated historical cost. The group changed from the revaluation model to the cost model under IAS 16 PPE in the year ended November 30, 2020, and restate all its assets to historical cost in that year, except for PPE or Mili, which had been revalued by the director of Mili on December 1, 2019. They have already done the revalue. So the value were incorporated in the various statements as a revaluation surplus of 280. So you need this one now. You need this value 280. The PPE of Mili were originally purchased on December 2018 at a cost of 1.2. These are set at depreciated over 6 years. Okay, the group does not make an annual transfer for revaluation reserve to retain any except for celebration charge. There were no additional charge. So this is very clear case. It's a very clear case. So the group currently adopts cost model. Somebody is at the entrance. So it's very clear case. The group currently adopts cost model. They have changed from revaluation model to cost model. So which means that you don't need to even have any to do with revaluation again. So they said that the group already changed from revaluation model to cost model under existing. And you know, under your cost model, you recognize your asset at cost less accumulated depreciation. So what they have not done is that these guys now revalued an asset and add a revaluation surplus of 280. So which you need to reverse since they are no longer using a cost model. I mean, they're no longer using revaluation model, they are using a cost model. So you have to reverse this 280 million revaluation reserve. This is not correct because the group is now adopting what is known as a cost model. Okay, so you say what do you say? Reclassification of revaluation reserve because the group is now evaluation of revaluation reserve. So they have taken it to credit. You now debit your revaluation reserve. So you are reversing it since they are already. We have been told that the group is adopting a cost model. So there is no need to adopt a revaluation model again. So this revaluation reserve, you need to reverse it. Now, there is going to be impact on depreciation when you are doing this kind of reversal. What is the impact of depreciation? The asset was
280.
purchased. It's
Sir,
280.
That's 280.
Thank you. I just want to be sure that you are following me. So the assets, they said that what did they say? They said something about the useful life of the assets. Where is it? Okay, let me read it again. Let's read. The policy of the group is to state PPE at depreciation historical cost. The group changed from revaluation model to cost model. So it's because of this that we are changing this. Okay. Restated is at cost, except for you cannot have an exclusion. Once you are adopting a cost model, it must be uniform. Once you are adopting a revaluation model, it must be uniform. So this except for is what we are changing now. Okay. Now this was done in 2019. So the value incorporated in the statement or something. I'm looking for the useful life. The assets are depreciated over a 6 years. Yes. The asset was depreciated over 6 years. And you are told that the asset was purchased in 2018, Abi? Hmm? Hello?
Yes, sir.
The asset was purchased in 2018, Abi? Okay. The asset
Yes.
was bought in December 2018. So, and the revaluation was done on December 1, 2019. That means 1 year is already gone, Abi. So you are left with only 5 years. Is that correct? It is 6 years when the asset was bought in 2018. Now, in 2019, you have done a revaluation. That means you are left with how many years? 5 years. Am I correct?
Yes.
Yes, sir.
It's 5 years,
Yes,
Abi. Then our reporting date is 2020. So what it means is that we need to now consider 1 year depreciation since the impact is just from 2019. So, and the remaining useful life is 5 years. So what you will credit is credit your P or F. It will be 1/5. 1/5 times 280. Then the balance is what you take back to PPE. PPE. So how much, please? 1/5 of 280.
56.
This one is 56. Then
56.
how much I will take it to PPE? 2
2 to 4.
2 to 4. 2 to 4.
2 to 4.
2 to 4. Okay. So that is all. We are done with this note. So what we have done is to reverse the entry they passed and we adjust for the depreciation based on the remaining useful life. So number 5 now, let's see the next note. Okay, it is a group policy to value NCI at. Yes.
This
I'm with you, madam.
the
It's
way
like
you do, I
someone
don't
is
understand it too. The note 5.
Okay, the way we treated it, Sabi. Should I
Yes, sir.
repeat it? I should repeat it, Abi.
Yes, sir.
Okay.
Yes, sir.
Yeah. Let's go now. Let's go. First of all, understand the group policy. The group policy now is to revalue PPE at cost model. Because before they were using revaluation model, now they are using cost model. And under cost model, you don't have anything like revaluation reserve. You measure your PPE at cost less depreciation. That is the first thing that you should note. You measure PPE at cost less depreciation. Okay, who's waiting? So PPE should be measured at cost less depreciation. That's what you should note. All right. So you are not told that for one of them now, they now say that they did one revaluation during the year. So I'm trying to get that statement. Yeah, they said except for the property of me limited. So you cannot have a selective evaluation. If you're adopting a cost model, it must be uniform. And if you're adopting an evaluation model, it must be uniform. So except for me limited, which will be revalued on December 1, 2019. So the value will incorporate the financial record, creating a surplus of 280. So this thing that they've done for me we need to restate it back to cost model. So that was why we debit 280. You know, if you recognize a revaluation of surplus, you credit gain. You credit it. Now we are reversing it. That was why we debited it. Now the question is, how much should we send back to PPE? You cannot send back everything. What you will send back is the value that has not been depreciated. And we said the total useful life of the asset was 6 years when it was bought in 2018. Now, December 2019, meaning that 1 year has already passed. So we are left with 5 years. So, and our reporting date is 2020. So what it means is that we are only after the depreciation from 2019 to 2020. That is 1 year. So that is why we said 1 divided by the remaining useful life, which is 5 years. Remember, it is 6 and 1 year has already expired. So 1 over 5 times 280, we got 56. Then the balance is what you send back to PPE. I don't know, is it clear now? Or Oluwaki? So that's my favorite name. Is that clear?
Yes, sir. But I'm not the one that asked to.
Okay, I thought you raised your hand now. Why did you raise up your hand?
Yeah, somebody was at the door. That's why.
The lobby. Okay, who asked me? I hope the person is okay now with the explanation.
Yes, sir.
Thank you. Thank you. Thank you. Thank you. You people need to go and make me proud, though. I think your exam is 2 weeks' time, Abby. Oh, I will be with you guys in spirit. Well, when are you guys writing in Ikeja or where? Which center? Is it Ikeja?
Airport
All over the
Hotel.
world.
Airport Hotel, and is it there is one distance too on Ijaola Road, some Pleasant. Is it Pleasant or something? Those event center. Let's see how it goes. I might visit Ikeja. Should I even come? If I come, I will distract you people. Let me stay, Jerry. I will not come. I will
Come,
distract you
sir.
if I. Eh? You said?
Come. You can
I
come,
should.
sir.
Is it at Ikeja?
Airport Hotel.
Airport Hotel. Okay. I hope you guys will not feel intimidated or distracted if you see me. Oh.
No.
Anyway, maybe on my way to work because that's where I pass through. I drive through every day, so I can just come say hi to you guys and vamos. But no revision or no time for revision that day. Otherwise, I will just scatter everything on your head. I will just scatter everything. So number 5. This one is employee benefit. Have you done IAS 19? Who taught you?
Compliance,
Yes,
sir.
Okay. Oh, that's a good job. I trust him. So during the year, the director of OMI decided to establish a development pension fund for employee of the parent company and contributed cash to the tune of 400 million. The following details were available. So we have the present value of the fair obligation, fair value of assets, current service cost, interest, expected return, accrued gain. So the only entry in the financial statement made today is the cash contribution, which has been included in trade receivable. So this cash has been settled already. The director have been uncertain on how to deal with the pension benefits or something. Anyway, just this one, when you see something like this, start dancing. It is very simple. First, identify the balance sheet item and pay your help. So this fair value of obligation is your balance sheet because it's your liability. Then fair value of asset is also balance sheet. It is your asset. Then current service cost is your P&L. Interest cost is your P&L. Expected return is your P&L. Then actual gain is your P&L. It could be OCI as well, depend. So these are those things that you need to adjust for now. So let's determine either we have a net pension asset or pension liability. How do you do that? This obligation is a liability asset here. So you will determine the difference between the two. Okay. That will give you that will tell you whether you have a pension asset or pension liability. So in this case now, what is our net pension? I think it's going to be pension liability because obligation is higher than the asset, right? So that's 20. Am I correct? Hello? Are you guys lost? Are you guys lost?
Sir, please can you take that again?
Okay, that was why I asked you whether you have been taught. So I assume you already know what I'm saying. So I just fire on my own, JJ. Okay, so under IAS 19, employee benefit. We have two methods. We can use a defined contribution or defined benefit. So under defined benefit, so this question is simply it's talking about the defined benefits, whereby there is a pension obligation that you have already set for your employee. So you need to finance the pension obligation through assets. So the objective is that whatever you have in your obligation should be equivalent to the asset. So which means that every year you must keep comparing your obligation with asset. So in this case now, our obligation is 520 and our asset is 500. What it means is that our pension obligation require additional investment of 20 million so that your obligation can match your asset. So that is why we have this pension obligation liability of 20 million, because the value of the obligation is higher than the value of asset. So all these ones that you are supposed to recognize in P&L, so you bring them up too. You bring them up. So all these P&L, you bring them up. So you bring all of them up. So current service cost is is an expenses, right? Interest is also an expenses. Expected return is an income. So you remove it from the expenses. Then actuarial gain too is also an income. So you remove this from your expenses. So what's the total net expenses, net expense for the year? What's our pension expenses for the year? Or total
420.
to be recognized in P or L. That's for what? 420.
420.
Okay, 420, right? Now, so this is what we should recognize in the P or L. This is what we should recognize in the P or L. So now, what is your accounting entry now? So accounting entry is first debit your P or L by 420, right? Then you are told that you have invested you sent money out, okay, to your receivable. So first of all, what is the pension liabilities now? So this one, you credit your pension liability. That's under your liability 20. That is, I'm referring to this one, 20 million. This pension liability, you recognize is 20. Okay. Then the balance is what you take in your trade receivable. You let it off from your receivable. You are told that the sum of 400 million was paid into your receivable. So that is the 400 million that you will use to net off this balance. Let me show you where that statement was made. They said that during the year, the director established a fund and contributed a cash to the tune of what? 400 million. So this contribution now is what they use in financing this. Okay. So the total you have in P&L is this, then pension liability is this. So the balance is offsetted with your trade receivable. I don't know if you understand, please, which is the cash they sent out. Let me put it in bracket. Cash. All right. So the P&L is basically all these expenses minus income. Then the pension liability is the difference between your obligation and assets. So once you pass these entries, you are good. Okay. Any questions, or can I move on? Okay, nothing. So we are done. So that means we are done with everything, Abby. So can you guys calculate a reserve, goodwill, and NCI so that we can move on to the next question? Can you do it? What
Sir,
is
please
left
just
now?
do it.
Why should I just do it now? Why should I do it?
Just do it. Thank you.
Just do it. Thank you. Just do it. Thank you. See, me, I'm just enjoying myself since I finished your class. In fact, I am sleeping now. What's this? I am sleeping now, sir. Oh.
We are
Okay.
missing
So,
you.
well, go and pass your exam. When you pass, hey, you can do 5G after your exam. But for now, concentration is pass your exam. Once you write your exam, if you jump for Ikeja, or we jam on the island anyway, we can do 5G there. But now go and pass your exam, that's the priority. Okay, so goodwill. Goodwill. How many do we have? How many subsidiary we have? So I'm going to combine this goodwill. Who is at the lobby? Esther. Esther is just, where is my friend? Maureen. I can't see her online, you know. She has been following up with me that I must solve this question. Anyway, thank God that it is being recorded, so she can always listen to the recorded version. Even Aisha, where have you been,
So
man?
I'm here. Oh,
Oh, Maureen, you are there. Why have you've been so quiet? What happened? Hmm?
sir. Nothing, sir.
And my class governor too. Okay. All right. Let's move on. So we have two subsidiaries. Who are they? Rua and Mimili. Where did I can't nobody say all these names? Mimili. So purchase consideration. What is the purchase consideration? We already know. Oh, there's something we not do here. The balance of 20% will be paid by the NCI of Rua, right? This indirect now. So we said NCI Rua, they will pay 20% of 400. That should be about 80. So the purchase condition is 2560 and 960. 2560, 960. So they said that we should use proportionate, Abby. So nothing spoiled. Just end this one here. Now, so what assets acquired now? Share capital. What's the share capital? Oh yeah. Share capital. Oh yeah, give me. 24 and 800. Abby?
Yes.
Then what is the pre-acquisition reserve? For Rua, what's the pre? 400, Abby?
Yes, it's 400.
Then what about the other guy? Mimile.
So for
Uh,
they said we're
Ruwa
200
is
million
No,
and
let's do it.
600
Let's do it.
million.
Let's do it together so that we don't mix it up. Okay, Omiya and Rua both acquire something the same day. Omi PLC acquire 40 and Rua acquire 50. Okay. The return any of Mimili at that date were 200 million. So it's very clear, 200 million. Okay, then we're given the fair value of identifiable assets of who?
hello,
They
sir.
said
Why
that
is
if
the rule at
Sir,
24, not 2000?
if you are picking the premium, you do not pick the premium of Mimili.
is there premium there? Show me.
Yes,
You pick share capital and premium.
for
Okay,
Ruwa, but you know,
it's 2000 now. Share capital is
Yes,
2000 now.
yes.
2000, there will be premium. That's 400 and 200.
Then they said that the fair value of identifiable assets of Rua is something.
2,418.
And the difference relates to net current assets, which has been realized anyway. What's the total that they gave us? Let's take the total first. 2000 what?
480. I'm 2,840.
2840, Abby. So can you
Mm-hmm.
determine the difference? This is 2008. It should be 40, Abby.
Yes.
Yes, sir.
Should be 40. So don't worry, I will show you how to treat. If it has been realized, I will show you. Okay. What about, did they give us for Mimili the fair value of identifiable asset for Mimili? Okay, they said the fair value of the net asset of Mimili were not materially different. That means same thing. So this one is 0. Now, total it. Can you total? This is 1, 2. Eh? Abi?
Yes, sir.
You know, ROA is 80%, Abi. How many percent is Mimele? I think it's 60.
60.
Correct? 60.
Yes.
So
60.
now, so what is the parent share? Parent share, 80% of 2,840 is what? What is 80% of 2,840?
2272.
2,270.
7 2.
7.
2272.
7,2.
Yes.
What
Yes.
about this one? 60% of 1, 2 is what?
720.
720.
720. So what is the, you know, we are going to do NCI too, but we don't need NCI now. Let's do it anyway. What is NCI? So 20% of 2,560 is what? Hmm? 20% of 2,560 of 2,840, sorry. 20% of 2,840.
568.
40.
568.
Then what about this one? What is 40% of 1, 2?
480.
4.
480.
So our goodwill is this A, this is B. So goodwill. So what is A minus B? Let me admit who is waiting. So what is the goodwill for RUA 2560 minus 2272?
288.
Hmm?
288.
What about this one? 960 minus 720.
240.
240.
Hmm?
240.
240. Abi? Like this. So the total is what now? 288 and 240 is what?
528.
528. Abi? Okay, so number 7. What is our reserves? We have Omi, Rua, Mimili. So this one is 80% and this one is 60%. Abi? So what is the reserve as per account? Give me.
Um, 25. 800 and 240.
25,
800,
800.
240.
So let's pre-acquisition reserve. So what is the pre for RUA?
400.
Hmm?
400.
Okay, so on the screen, sir.
Yes.
400 and 200. So what is our post?
440.
Post acquisition reserve.
440.
140. So share of post.
320.
Hmm?
320.
And
And 24.
so you now need to start adding everything again. Let's start from the top. Number 1, nothing. Number 2, yes. 80. Number 3 to excess depreciation.
Depreciation 3.2.
I mean, trade discount 24. Excess depreciation. Wait, so sorry. If it is excess depreciation, I think our entry should be reverse. If it is excess, I'm sorry. Excess depreciation, this PPE should be debited. You know, we need to reduce. We have charged more depreciation, so we need to reduce our depreciation. So PPE, it should be like this. I'm sorry. Debit and you credit. I mean, you credit your income statement. Excess depreciation means you have charged more, so you want to reduce it. So I'm sorry. So let's first of all take discount 24 and excess depreciation 3.2. Discount on PPE. That's 24. Then excess depreciation 3.2. Right?
Yes, sir.
Yeah, it has been taken note now. Then this one,
Then
56.
56.
Revaluation is 56. Are we adding or lessing? Let's go back. We are crediting, yeah, we are adding. Then there is 420 pension. Okay. Any other thing again? Okay, can you give me the total of everything?
Sir, please can you scroll up?
25, 320, 24 minus 80 minus 24.
Sir, please scroll down.
Thank you.
Thousand 219.2.
2,000,
3,000
3,000.
219.2.
Point what? Okay, like this, Abby.
Yes, sir.
So, last one is NCI. NCI. So we have two RUA. So what is the
Yes, sir.
NCI?
Please,
NCI value. You want to say something?
yes. Why are we adding the liability, the pension
No,
liability?
not liability now. Pension. I mean, pension cost is not. Let's call it cost. It's not a liability. All those total cost is not liability is 20, right? Pension cost. Oh, sorry, we should deduct. You are correct. Oh yeah, madam, please recalculate it. She is right. We should deduct. Please do it again.
Sir, please scroll down.
I should scroll down now.
Yes. $2,379.2.
So what is our NCI valuation? We know it here. That's 568 and 480. 568, 480. So you know this guy needs to pay NCI purchase consideration. That's RUA. He needs to pay back his debts. So how much is he supposed to pay back as purchase consideration?
Eight.
Dash 80. Abi? So
Yes.
then what is the share of post acquisition? What is the share of post acquisition? 20% of 40, that should be 80, and 40% of 60. It should be 80. 20% of 400, Abi. Then what about 40% of 40% of 40?
40, yeah.
16.
16. So I think there are a couple of adjustments that needs to go through this our NCI. Let's pick them from the beginning one by one. Number one, no. Number two, no. Number three, the way out, yes.
Yes.
We are sending 0.8, Abi.
Yes.
0.8. What is next? Where else again do we have NCI? Nothing, Abi.
Yes, sir.
That's all.
That's all.
Okay. So what's the total now?
$567.2 for rural.
What about this guy? 496,
49.
Abi.
Yes.
Okay, there is a doubt I have here. Let's brainstorm. If you look at this note, this three discounts now, if we are adjusting excess depreciation with NCI, I think we should also adjust this for PLL too. All right, let's read that note again. I want to be sure. Discounts, whether it is subsidiaries, asset or okay. Look at it. RUA had purchased a significant amount of interest. The cost before trade discounts, the trade discount that we taken to income statements. I think we should adjust it since it is RUA, it is a subsidiary, right? So this trade discount should be 80-20, please. I'm sorry. Because the same trade by go for excess depreciation should also affect the main item. So 80 of 24, please. Please, 80 of 24.
19.2.
19.2. Then this one, 20, that's 4.8, Abi.
8. Yes.
Yeah, so we'll come here. We have 19.2.
19.2.
Then we have 4.8.
Yes.
Discounts. Okay, so you need to help me rehash it. Please do this one first. What's the new total for NCI?
562.4.
Hmm?
562.4.
So let's do the reserve again. What about this one? Let's do it again.
Sir, please scroll down. 2384.
2384. Point what?
No,
Point what? No point.
no points.
Okay. All right. So we are done now. We are done, ladies and gentlemen. So we need to. That's the end of the solution. All right. So kindly
So
balance
you
the
say you're
account
going to
on.
show us.
Eh?
So I say you're going to show us how to make the entry for that net current. I mean, the inventory. I mean, that's.
Oh, it will even affect our solution. Oh, what is wrong with me this morning? You see now, I'm already in relaxation mode. I'm out of the class mode now. So this 40-year net current asset, it has been realized. So if it has been realized, anyway, it will only affect our reserve. Number 7. So we call it realization of net current assets. Okay, it is for RUA. So if it has been realized, that means you debit your P or L. How much is this? 40, Abi? You understand,
There's
Abi?
no need to be spread between both of them.
Credit. Sorry, 1 minute. Credit your net current assets. That's 40. You know, when we're on recognition now, when we recognize the net current asset, we will have passed this entry. Debit net current assets 40, Abi, and credit net assets acquired 40. So this is what we will have done for this 40 year. Do you understand? This 40 that we introduced, this is what we will have passed for it. So now we were told that it is realized. That is, it is realized. So once it is realized, all you have to do is that whatever you have recognized, so you just nail it off. So this one now has been nailed off with this. It has been cancelled out. Somebody's at the lobby. Esther is just coming and going. So this 40 that you recognize here on recognition, it has been realized, so it has been nailed off. So where will you realize it to? It's to P or help. So you do 80-20, please. What's 80 of 40 and 20 of 40? That should be 32-8, Abi.
Yes.
32-8. Unfortunately, we need to adjust our NCI and this thing again. Call it realization. Thank you for reminding me. Or may I've forgotten. No? I think it was in the last question also, right? The one we did last time. 32. I mean, this will be 8. This is 8, and this is 32. So can we do it again now? So please, let me total this again, please. Thank you for reminding me of that realization. I've forgotten, because it will affect your solution. It will affect it.
3,192.
3,000.
192.
How is it 3,000? It's only 32 now. It can't be 3,000. No. It should be less now. Check it again. It can't be up to 3,000 now. It should be less than 2,000 something. 2,000. Please tell me now.
2,352.
2,000.
350.
352. Then you redo the NCI again. What is this NCI again?
554.4.
554. Okay. At last, we are done. We are done. Let me first of all stop recording. I will load it up for you guys so we can watch the replay. So I have
I have
one more question.